Let me tell you about a mistake that's quietly costing retirees tens of thousands of dollars, and most of them don't even realize it's happening until it's too late. I was sitting down with a couple recently. Let's call them David and Susan. David was 73, Susan was 71. They had done everything right. They saved diligently for decades, had about $1.2 million sitting in their traditional IRA, Social Security coming in, a modest pension, and they were feeling pretty good about retirement. But when we sat down and actually ran the numbers together, David went quiet. Because what we discovered was that over the next 10 years, they were going to pay somewhere between $80,000 and $87,000 more in taxes than they needed to. Not because of bad investments, not because of bad luck, because of one single strategic mistake that millions of retirees are making right now in 2026. And here's the painful part. It's completely avoidable. So in today's video, I'm going to walk you through exactly what that mistake is, why it's so expensive, and more importantly, what you should be doing instead. We're going to talk about RMDs, Roth conversions, how they interact with each other, what the 2026 tax rules mean for you specifically, and I'm going to give you a clear, actionable strategy you can actually use. Whether you're already taking RMDs, approaching that age, or you're still a few years out and want to plan ahead, this is going to be one of the most important videos you watch this year. So let's get into it. First, let's make sure we're all on the same page about what we're actually talking about, because I find that a lot of confusion in retirement planning starts with people using these terms interchangeably when they're actually very different things with very different rules. An RMD, a required minimum distribution, and is exactly what it sounds like. It's required. The IRS mandates that once you reach a certain age, you must start pulling money out of your tax-deferred retirement accounts every single year. We're talking about traditional IRAs, 401ks, 403bs, SEPIRAs, any account where you got a tax deduction when you put the money in. The government let you defer those taxes for decades, and now they want their share. The age at which this kicks in, thanks to the Secure 2.0 Act, is now 73. And if you were born in 1960 or later, that age is going to be 75. The amount you have to take out is calculated using your account balance at the end of the previous year divided by a life expectancy factor from the IRS tables. And here's the thing about RMDs. You don't get a choice. You have to take them. If you don't, the penalty is 25% of the amount you were supposed to withdraw. That's not a typo. 25%. So RMDs are mandatory. They're taxable as ordinary income, and they happen every year whether you need the money or not. A Roth conversion, on the other hand, is a voluntary decision. It's when you take money that's sitting in one of those tax-deferred accounts and you move it into a Roth IRA. You pay the taxes on that money now in the year you convert, and then that money grows completely tax-free forever. Your future withdrawals from the Roth are tax-free. And here's something a lot of people don't know. Roth IRAs have no required minimum distributions during your lifetime. None. Which means if you convert money into a Roth, you control when and whether you take it out. That's a massive difference. So RMDs are forced, taxable, and recurring. Roth conversions are voluntary, taxable upfront, and designed to reduce your future tax burden. They sound similar on the surface. Both involve moving money and paying taxes, but the strategy behind each is completely different. And understanding that difference is the foundation of everything we're going to talk about today. Now, let's get to the mistake. The big, expensive $87,000 mistake. Here's what most retirees do. They turn 73, they get their first RMD notice from their brokerage or their IRA custodian, and they just take the distribution. Maybe they spend it. Maybe they move it into a regular taxable brokerage account. Maybe they reinvest it somewhere else. And then the following year, they do the same thing. And the year after that, the same thing. They treat RMDs as something that just happens to them rather than something they can plan around. And while they're doing this, they're leaving their Roth conversion window completely untouched. Or worse, and this is the really painful version of the mistake, They try to do Roth conversions on top of their RMDs without understanding the tax stacking problem, and they end up paying significantly more in taxes than they needed to. Let me show you exactly how this plays out with a real example so you can see the numbers. Take someone like David, our 73-year-old from earlier. He has $1.2 million in his traditional IRA. Based on the IRS life expectancy tables, his first RMD is going to be roughly $47,000. He and Susan have Social Security income of about $42,000 combined. So just from those two sources alone, before David has touched a single additional dollar, they have about $89,000 in taxable income. Now the standard deduction for a married couple filing jointly in 2026 is $30,600. That brings their taxable income to about $58,400. That puts them firmly in the 22% tax bracket. Okay, that's manageable. But here's where the mistake happens. David has been reading about Roth conversions. He knows they're a good idea. He's heard that you want to convert before 2026 because the Tax Cuts and Jobs Act provisions are set to expire, and we'll talk more about that in a minute. So he decides to do a Roth conversion of $100,000 on top of his RMD. Now his taxable income isn't $58,400 anymore. It's $158,400. He has just pushed himself into the 24% bracket and is bumping up against the 32% bracket. But it gets worse, because at that income level, up to 85% of his Social Security becomes taxable. His Medicare IRMAA surcharges kick in. Those are the income-related adjustments that increase your Medicare Part B and Part D premiums, and those are based on your income from 2 years prior. His net investment income tax exposure increases. And if he has any capital gains, those may now be taxed at a higher rate than they would have been otherwise. The cumulative effect of all of this, stacked together over a decade of poor coordination, is where that $87,000 number comes from. Sometimes it's more. I've seen cases where it's well over $100,000 in unnecessary taxes paid. And the brutal irony is that David was trying to do the right thing. He was trying to be proactive. He just didn't understand how these pieces fit together. So let's talk about what the SMART approach actually looks like, because this is where things get really interesting. The number one rule of coordinating RMDs and Roth conversions is this: your RMD always comes first. This is not optional. The IRS has a rule that says you cannot convert your RMD to a Roth. You must take the RMD out first, and only then can you convert additional amounts. A lot of people get confused on this and think they can just convert everything, including the RMD amount. You cannot. The RMD has to come out, it's taxable, and then if you want to do a Roth conversion, that conversion is calculated on top of whatever your RMD was. So the first step in any SMART strategy is to calculate your RMD for the year, take it, and then figure out how much room you have left in your current tax bracket before you start doing Roth conversions. That phrase, "how much room do I have in my current tax bracket?" is the key concept here. Think of your tax bracket as a container. Every dollar of income you receive is filling up that container. Social Security, pension income, RMDs, part-time work, investment income, all of it goes in. And you want to know exactly how much space is left before you spill over into the next bracket. Because any Roth conversion you do should ideally fill that remaining space without pushing you into higher territory. Here's a practical example of how to think about this. Let's say after your RMD and Social Security, your taxable income is $65,000 as a married couple filing jointly. The top of the 22% bracket in 2026 for married filing jointly is $201,050. That means you have approximately $136,000 of room before you hit the 24% bracket. Now, you probably don't want to convert $136,000 in 1 year. That's a lot of taxes to pay at once, and you need to consider your cash flow. But you might look at converting $30,000 or $40,000, which fills some of that bracket efficiently without triggering the IRMAA cliff or pushing you into unnecessarily high territory. This is what I call bracket optimization. You're not trying to avoid taxes completely. That's impossible. You're trying to pay taxes at the lowest possible rate on every dollar you convert. And if you do this systematically, year after year, in the years before your RMDs get really large, you're essentially prepaying taxes at a lower rate so that your future self pays less. That's the entire logic of the strategy. Now, let me address the 2026 factor specifically, because this is genuinely time sensitive and I don't want you to miss it. The Tax Cuts and Jobs Act was passed in 2017, and it temporarily lowered tax rates across the board. Those lower rates were never made permanent. They're set to expire at the end of 2025 unless Congress acts. And as of right now, in 2026, we are either in a world where those rates have been extended, or we're in a world where they've reverted to the pre-2017 levels. This is something you need to check right now with your advisor or look up the current legislation, because the outcome dramatically changes the math. If rates reverted to pre-2017 levels, the 22% bracket that many middle-income retirees sit in may now be 25%. The 24% bracket may now be 28%. That's a meaningful difference. It means that Roth conversions you could have done in 2024 or 2025 at 22% might now cost you 25% or more, which is exactly why the people who planned ahead and did their conversions in those lower rate years, they made out extremely well. And if rates are still elevated going forward, the urgency around conversion timing only increases. The broader point is this: tax rates are a variable, not a constant. The assumption that your taxes will be lower in retirement than they were during your working years is often wrong. Between RMDs growing your taxable income, Social Security being partially taxable, and the possibility of higher rates, many retirees actually end up in a similar or higher tax bracket in retirement than they were during their peak earning years. That's the exact situation where Roth conversions provide the most value. There's another piece of this puzzle that most people don't think about until it's too late, and that's what happens to your spouse if you pass away first. When one spouse dies, the surviving spouse files as single rather than married filing jointly. The tax brackets for single filers are much narrower. The same amount of income that was in the 22% bracket as a married couple might now be in the 32% bracket as a single filer. And that surviving spouse still has to take the full RMD, still receives Social Security, and potentially has a larger IRA now that they've inherited. The tax bill doesn't go down when someone passes. In many cases, it goes up significantly. Roth conversions done before that event can dramatically reduce the surviving spouse's tax burden. This is one of the most compelling reasons for couples to be aggressive about conversions in their early retirement years when both spouses are alive, both are presumably healthy, and they can still coordinate their finances together. Let me give you the framework I use when working with clients to put all of this together. Step 1. Calculate your RMD for the current year. Take it first. Do not skip this step, and do not try to roll it into a conversion. Step 2. Add up all your other sources of taxable income for the year. Social Security at 85% if applicable, pension, part-time work, investment income. Know exactly where you stand. Step 3. Subtract your standard deduction or itemized deductions to find your taxable income before any Roth conversion. Step 4. Determine how much room you have left in your current tax bracket. Decide how much of that room you want to fill with a Roth conversion this year. Step 5. Be mindful of the IRMAA thresholds. In 2026, the first IRMAA cliff for Medicare is at $106,000 for an individual and $212,000 for a married couple. Crossing those thresholds triggers premium surcharges based on your income from 2 years ago. So if you're close to those numbers, be careful about how much you convert. Step 6. Consider the source of funds to pay the tax. Ideally, you are paying the conversion tax from taxable savings, not from the IRA itself. If you pay the tax from the IRA, you're effectively reducing the amount that gets converted, and the compounding benefit is diminished. Step 7. Repeat this process every year. Roth conversion is not a one-time event. It's a multi-year strategy. The people who do small, consistent, bracket-optimized conversions over 5, 10, or 15 years tend to come out far ahead of those who try to do a massive one-time conversion. And finally, let me address the question I get asked all the time. Is it too late to start? If you're already 73, 75, 78, is there still value in doing Roth conversions? The answer is yes, with nuance. The math changes as you age. The break-even period on a Roth conversion, meaning how long it takes for the tax savings to outweigh the upfront tax cost, gets longer as you get older. But for most people, the beneficiary angle alone makes it worthwhile. Your children or heirs who inherit a Roth IRA do not owe income taxes on those distributions. They do have to take distributions within 10 years under the Secure Act rules, but those distributions are tax-free. Whereas if they inherit a traditional IRA with $500,000 in it, every dollar they pull out is taxable at their income tax rate. If your kids are in their peak earning years when they inherit, that could be a 32% or even 35% tax rate on money you deferred your entire life. Converting now, paying taxes at 22% or 24%, so your children inherit it tax-free. That math often works out beautifully. The bottom line is this. The $87,000 mistake isn't one dramatic decision. It's a series of small, uninformed choices made over years. Taking RMDs without thinking about conversion opportunities. Doing conversions without understanding the tax stacking effect. Ignoring IRMAA thresholds. Not accounting for single filer risk, and assuming that the current tax environment will always look the way it does today. The antidote to all of that is intentional, coordinated, year-by-year planning. David and Susan, by the way, we fixed their strategy. We redesigned their conversion plan, made sure we were staying within the optimal bracket each year, and built in IRMAA buffers. Over a 10-year projection, we reduced their estimated tax liability by just over $84,000. Same accounts, same income, just smarter coordination. That's what this is about, not exotic strategies or loopholes, just knowing the rules, understanding how the pieces interact, and making deliberate decisions every single year. If this video was helpful to you, I'd love it if you'd hit that like button. It genuinely helps more people find this content when they need it. And subscribe if you want to keep getting this kind of practical, no-nonsense retirement planning strategy. I put out new videos every week. Drop a comment below and tell me where you are in this process. Are you already taking RMDs? Are you in that conversion window before they kick in? Are you already doing conversions and wondering if you're doing them right? I read every comment, and I often use your questions to decide what to cover next. And if you want to go deeper on any of this, I have a complete guide linked in the description below that walks through the bracket calculations, the IRMAA thresholds, and the conversion worksheet I use with clients. It's completely free. Go grab it. I'll see you in the next one.